Hey, what's up, guys? Reed M27, just an average dude. I've made tons of money mistakes in my 20s, and now I want to share everything I've learned to help you take control of your finances and your life so you got some extra cash and you want to invest it. Maybe you finally saved up a little something after paying your bills, and you feel like, okay, maybe it's time to be an adult about this whole money thing. But then you open up your phone and you see all these videos about options trading and crypto and meme stocks and some guy named Warren Buffett something, and honestly, it gets overwhelming real quick. I remember the first time I tried to learn about investing. I was 23, sitting in my tiny apartment eating instant noodles and watching some finance guru talk about alpha and beta and expense ratios. And I literally closed my laptop and said, forget it. It felt like everyone else already knew this secret language, and I was just sitting there trying to figure out how to not overdraft my bank account. But here's the thing, I figured it out. Not because I'm smart, not because I went to some fancy school, but because I kept it simple and I started small, and now I'm going to show you exactly what I learned so you don't have to waste years like I did. So let's break this down into a few parts. First, why you should even bother investing. Second, what you should actually put your money into. Third, when to start and how much you need. Fourth, I'm going to show you a live walkthrough of me buying a stock on camera so you can see how easy it really is. And fifth, we will talk strategy and taxes because nobody really explains that part. All right, let's start with the most important question, why invest at all? I used to think investing was something only rich people did, or people who worked on Wall Street wearing fancy suits and yelling at computers. I thought you needed thousands of dollars to even get started, and honestly, I was wrong. The main reason you should invest is simple. You want your money to work for you instead of you working for your money. Think about it this way. You get a paycheck, you work 40 hours a week, you trade your time for money, but once you spend that money on rent and food and boring stuff, it's gone. You have to go back to work again next week and do it all over. But when you invest, your money stays in the game. It keeps growing even while you are sleeping or eating or hanging out with your friends. Your money basically gets a little side hustle and works overtime for you. Let's say you have an extra $1,000 sitting around. What are you going to do with it? You could buy some new shoes that'll be out of style next month. You could stuff it under your mattress, which honestly my grandma used to do, and it didn't work out great for her. Or you could put it in a bank savings account earning like 0.01% interest. The problem with all of those options is inflation. Inflation is basically this sneaky thing that makes your money worth less over time. Remember when a bag of chips used to cost $1? Now it's like $3, that's inflation. Your dollar buys less stuff every single year. So if you just leave your cash sitting in a savings account or under your mattress, you are actually losing money every year because prices go up, but your money stays the same. Investing helps protect your money from inflation and hopefully grows it too. Now, how does your money actually grow when you invest? There are two main ways. First, when you buy a piece of a company like Apple or Microsoft, you basically own a tiny little slice of that business. If the company does well and makes more money, your slice becomes more valuable. So you make money because the business you own is worth more. It's like if your friend started a lemonade stand and you gave him $20 to help buy lemons and sugar, and then his lemonade stand became super popular, and now your $20 is worth 50 because the business grew. That's basically it. The second way your money grows is through compound growth. This is a fancy term that sounds complicated, but it's actually really simple. Compound growth just means you earn money on your original investment, and then you also earn money on the money that your money made. Wait, what? Let me explain with a real example. Remember that extra $1,000 we talked about? Let's say you invest it and it grows by 10% every year. At the end of year one, you have $1,100. Your original $1,000 plus $100 in growth. Nice. Now here's where it gets fun. In year two, you are not just earning 10% on your original $1,000 anymore. You are earning 10% on the full $1,100. So you make $110 that year, bringing your total to $1,210. In year three, that 10% growth is now $121. So your total is $1,331. See what is happening? Every year you are making money not just on your original $1,000, but on all the growth from the previous years too. It's like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow and gets bigger and faster. Albert Einstein called compound interest the eighth wonder of the world. I don't know if he actually said that, but it sounds cool and it's true. Now, the key thing to understand is that compound growth takes time. It is not a get-rich-quick thing. It is a get-rich slowly and steadily thing. But if you give it enough time, even small amounts of money can grow into something significant. All right, so now you have an idea why investing matters, but what should you actually invest in? This is where most beginners get confused and end up making bad decisions. When I first started, I thought the smartest thing to do was just look at what stocks went up the most and buy those. I figured if a stock went up 50% last year, it would probably go up 50% again this year, right? Wrong. Here's the problem with that thinking. The stock market does not work like a simple pattern you can predict. Just because a company did well in the past does not mean it will do well in the future. Think about Nokia. Back in 2010, Nokia was the king of phones. Everyone had a Nokia. You could drop it off a building and it would still work. They owned almost 40% of the phone market. But by 2020, their market share dropped to less than 1% and their stock price fell by almost 70%. If you had put all your money into Nokia back in 2010, thinking it was a safe bet, you would have lost a lot. Or think about the biggest companies 40 years ago. In the 1980s, the big names were oil companies and General Motors and DuPont. 20 years ago, it was Exxon and Walmart and Cisco. Now the biggest companies are Nvidia and Tesla and Google. Things change, so what does this mean for you as a beginner? It means you should not try to pick individual stocks on day one. You have probably heard the saying, don't put all your eggs in one basket. If you invest all your money into one company, that is exactly what you are doing. One basket, if that basket drops, you lose everything. Instead, the smartest and easiest thing for a beginner to do is invest in something called an index fund. An index fund is basically a collection of many different companies all bundled together into one investment. Let me break it down super simple. An index is just a list of companies. You have probably heard of the S&P 500 before. That is an index of the 500 largest companies in the US. A fund is just a pool of money that a bunch of investors like you and me put together. So an index fund is a pool of money that invests in that list of companies. When you buy one share of an index fund, you are basically buying tiny pieces of hundreds of companies at once. This instantly reduces your risk because if one company does badly, the other companies in the fund can balance it out. Even Warren Buffett, who is basically the grandpa of investing, said that most people are better off investing in a low-cost index fund than trying to pick individual stocks. And if Warren Buffett says it, I am going to listen. One of my favorite index funds is called QQQ. It tracks the NASDAQ 100, which is basically the 100 largest tech companies in the US. When I invest in QQ, I am investing in Nvidia and Microsoft and Apple and Amazon and Google all at the same time. My eggs are spread across 100 different baskets. Another thing to know about index funds is they come with a fee called an expense ratio. This fee covers the cost of running the fund. Most good index funds have very low fees like 0.02% or 0.05%, so you barely even notice it. Now, the big question a lot of people ask me is when should they start investing? And honestly, this might surprise you, but I do not think everyone should be investing right away. It depends on two things. First, do you have any high interest debt? If you have credit card debt with a 25% interest rate, that needs to be your priority before anything else. Here is why. Let's say you have $10,000 and you invest it in the stock market and you get a 10% return. You make $1,000. Sounds great, but if you also owe $10,000 on your credit card at 25% interest, you are paying $2,500 in interest that year. So you actually lose $1,500 overall. Paying off that debt first is like fixing a leak in your gas tank before you start filling it up. Second, do you have an emergency fund with 3 to 6 months of living expenses? Life happens. Your car breaks down, you lose your job, your dog eats something weird, and you have to go to the vet. If you do not have an emergency fund, you might be forced to sell your investments at a bad time or put an emergency on your credit card, which takes you right back to the debt problem. So before you start investing, take care of your high interest debt and build that emergency fund first. Once those are handled, you are ready to start. Now, how much money do you need to start investing? This is the part that surprised me the most. You can start with literally $1. I am not joking. A lot of brokerage apps let you buy fractional shares, which means you can buy a tiny piece of a stock or index fund even if you only have a few bucks. But obviously, how much you make depends on how much you put in. If you invest $10 and your investment goes up 10%, you made $1. If you invest $50,000 and it goes up 10%, you made $5,000. So the more you can invest, the better, but don't let that scare you away from starting small. My rule of thumb is only invest money you do not need for at least the next several years. The stock market goes up and down in the short term. If you need your money next year for a down payment on a house, you should not invest it because you might have to sell when the market is down. But if you can leave it alone for 5 or 10 years, the odds are very good that it will grow. All right, so now let's talk about how to actually buy your first investment. I am going to show you a live walkthrough of me buying a stock so you can see exactly what it looks like. First, you need a brokerage account. This is just an account where you hold your investments. There are a lot of options out there: Fidelity, Schwab, SoFi, Robinhood, Moomoo. They all work. I personally like SoFi because it is super beginner friendly and the app is simple to use. Once you sign up, you need to move money from your bank into your brokerage account. This is called depositing funds. You just link your bank account, type in how much you want to transfer, and wait a couple days for it to show up. Now, let's say I have some money in my account and I want to buy Apple stock. I open the app, go to trade, click on buy and sell, and type Apple into the search bar. Then I see Apple stock and I click on it. It shows me the current price, the chart, how it has been performing. I click on buy and it asks me if I want to buy in shares or in dollars. If I buy in shares, I am saying I want exactly 1 share of Apple. If Apple is $277 per share, I need at least $277 to buy 1 full share. If I buy in dollars, I can say I want to invest $100 and the app will automatically buy a fraction of a share. For this example, I have enough to buy 1 full share, so I type in 1 share and hit review. Then I slide to confirm and boom, I own 1 share of Apple. It is that simple. If I ever want to sell, I just go back to the Apple page, click on sell, and do the same thing in reverse. But honestly, my advice is don't sell. Hold your investments for the long term. I used to think I was smart enough to buy low and sell high. I thought I could watch the news and predict what would happen next, but I learned the hard way that nobody can predict the market. Not the experts, not the television people, not your friend who says he knows a guy. When the market drops, and it will drop, a lot of people panic and sell because they are scared. But panic selling is actually the #1 way people lose money. Let me show you why. Look at QQQ. Back in 2007, it was trading around $50 per share. Then the financial crisis hit in 2008 and QQ dropped all the way down to about $20. If you had bought at $50 and sold at $20, you would have lost more than half your money. But if you held on and did nothing by 2010, the price was back up to $50. By 2018, it was $170. And as of late 2025, it is over $600 per share. So if you just held on, your $50 became $600, that is 12 times your money. But that only happens if you do not let fear control your decisions. There's a study that showed if you missed the 10 best trading days over a 10-year period, you would lose about 66% of your potential gains. That is huge. The simple truth is time in the market beats timing the market. Most people who try day trading lose money. Some studies say only about 1% of day traders are consistently profitable. 1%. Those are terrible odds. So here's my advice for beginners. Pick a good index fund, buy it, and then forget about it. Do not check your portfolio every day. Do not panic when the market drops. Just keep adding money when you can and let time do the work. Let me share 3 index funds I personally like that have very low fees. First is S&P 500, which is the 500 largest US companies. It is super diversified and has an expense ratio of only 0.02%. This is great for people who want steady, reliable growth. Second is VUG. This is a growth fund that focuses on companies expected to grow faster than average. These are riskier but have higher potential returns. Great for younger investors who have time to ride out the ups and downs. Expense ratio is 0.05%. Third is SHD. This focuses on companies that pay dividends, meaning they send you cash payments every few months. This is better for people who want passive income or have a lower risk tolerance. Expense ratio is 0.06%. Now let's talk about taxes really quick because nobody explains this part and it is actually important. When you sell an investment for more than you paid for it, that profit is called a capital gain, and the government wants a piece of it if you hold an investment for less than a year before selling. That is a short-term gain and it gets taxed at your regular income tax rate, which can be pretty high, but if you hold for more than a year, that is a long-term gain, and it gets taxed at a lower rate. This is another reason to invest for the long term. It saves you money on taxes if you sell an investment for less than you paid for it. That is a capital loss and you can actually use it to reduce your taxable income. So there is some silver lining there. Honestly, I used to stress about taxes a lot, but over time I realized that as long as you hold your investments for the long term, the tax impact is manageable. The bigger mistake is not investing at all because you are scared of taxes. Look, I am not some Wall Street expert. I am just a normal guy who made a lot of dumb money mistakes in his early 20s. I used to spend my whole paycheck before I even got it. I had credit card debt. I had no savings. I had no plan for the future, but I decided things had to change. I started reading. I started learning. I started small, and over time,